Hello, everyone. Before we dive into today's content, I want to take a moment to share an important disclaimer. Please note that the information provided in this video, including any links, resources, or references, is for educational and entertainment purposes only. I'm not a financial advisor. I'm not a legal expert. I'm not a professional in the field of finance or law. The content shared today is not intended as and shall not be understood or construed as professional advice. Any financial or legal decisions you make after watching this video should be made after consulting with a professional in their respective field. I will not be held responsible for any actions you take or decisions you make as a consequence of the content of these videos. Furthermore, while we strive to provide accurate and up-to-date information, the financial and legal landscapes are constantly changing. Therefore, I cannot guarantee the complete accuracy of the information shared in these videos at the time you watch it. Investing in financial markets involves risk, and there is always the potential of losing money when you invest. Past performance is not indicative of future results. By continuing to watch this video, you agree to not hold me, the creator of this video, liable for any losses or damages resulting from the information provided. Thank you for your understanding, and now let's get into the video.
How to use your home equity to buy a second property. Have you ever wondered how you could leverage the equity in your home to buy a second property without facing any penalties? You might think this is complicated or risky, but that's a big mistake. Today I'm going to show you exactly how to use the home equity to make your next big investment. Stay tuned because this could be the game changer you've been looking for. Let me share the quick story of how I successfully used home equity to purchase a rental property. It turned out to be a fantastic investment. Using your home equity can be a smart way to expand your real estate portfolio without dipping into your savings or taking a high interest debt. Imagine purchasing a second property that generates a rental income, increase your wealth, and diversifies your investment portfolio. Plus, if done correctly, you can avoid the penalties and make your money work for you at the end of the day. For instance, I was able to buy a duplex in a growing neighborhood, and the rental income covers the loan payments while adding to my overall net worth. I remember when I first learned about leveraging the home equity, I was skeptical, thinking it was too risky or it would complicate my finances. But once I understood the process, it opened up so many opportunities. And I'm here to share those insights with you today. Understanding this strategy could mean the difference between a slowly saving for years or making a strategic investment now. So as we go into this framework, we'll start with a couple of steps. Understand home equity loans and HELOCs. First, let's talk about the two main ways to access your home equity. You have home equity loans and you got home equity lines of credit, HELOC. A home equity loan gives you a lump sum upfront with a fixed interest rate, ideal for predictable payments and specific investment amounts. For example, when I bought my second property, I knew exactly how much I needed, so a home equity loan was perfect. HELOC works like a credit card with a revolving balance and a variable interest rates, offering some flexibility for your ongoing projects such as renovations, phased out investments. Each has its pros and cons, so choose based on your financial situation or your goals. Now, if you want to go into it, you need to calculate your numbers. Your available equity by subtracting your outstanding mortgage balance from your home's current market value. Typically, lenders allow you to borrow up to 80 to 85% of your home's value. For higher value properties called jumbo HELOCs might be a different option. It's wise to talk to your professional appraiser or consult with multiple lenders to understand their terms and ensure you have an accurate picture of your available equity. For instance, if your home is valued at $600,000 and you owe $250,000, you might be able to access about $170,000 to $230,000 equity. So here we've switched over to a whiteboard so you can visualize what that looks like as far as the numbers that I just mentioned to you. So with that, it's a quick example. You got the home value is $600K. Your mortgage balance is your $250K. To identify your potential equity, you're going to take your 600 minus the balance of your mortgage, and that's $350K. All right, that you got left over. Then you're going to take the borrow amount, which is roughly, to decipher, that's your 85% your home value. So if you take the 85% of your home value, that gives you your borrow amount,
which is 510K, right? And that's the bank saying, well, we'll give you, 85% of that value. But if you have a debt on that value, which you do, that's 250K for mortgage that you have left on it. That means you got to now take the available equity calculation, which gives you your 510, your 85% of that subtracted 250, which is the debt that you have left right now, and that give you 260K on pretty much what you can borrow from the bank. So that's a good example. If you're taking the 260K, that's a lot to get into a deal. That could be, depending on the market that you're in, that could be 2 or 3 deals, honestly, depending on the market that you're in, because some deals are very low cost to get in and get out. Definitely is a great tool that I would recommend looking at. All right, so let's continue on. Now, it's time to shop around. You've done your number crunching. Now compare multiple lenders to find the best deal with the competitive interest rates, low fees, favorable repayment terms. Look for a lower APR to reduce your overall borrowing costs, and consider lenders offering rate locks to protect against the interest rate increase. Don't hesitate to negotiate better terms, especially if you have a strong credit score. In my experience, taking the time to compare offers saved me a significant amount of money, especially on the interest of the life of the loan. It's crucial to understand the risk and benefits. Using home equity can significantly boost your wealth, but it also means taking more debt. Ensure you have a solid plan and a cushion for unexpected expenses. Benefits include lower interest rates, potential tax deductions, but the risk of the market fluctuation and increased debt requires careful planning. One key benefit I experienced was the ability to invest in high-demand rental market, ensuring steady income and property appreciation. Finally, once you have secured your financing, use the funds to purchase a second property. Focus on areas of the high rental demand and good growth potential. Work with a real estate agent or property manager to find the right property, and ensure you have a clear financial plan in placing for maintenance and unexpected expenses. This strategic approach can make your investment profitable and sustainable. Pretty much, for example, if a property's purchase was on a growing neighborhood with new infrastructure projects enhancing long-term value, as we mentioned earlier, planning for a variable rate is crucial when using a HELOC. Variable rates mean that your monthly payments can fluctuate based on the changes in the prime rate. The prime rate is the interest rate that commercial banks charge their most credit-worthy customers, and if often serves as a benchmark for other interest rates, including HELOCs. To prepare for these fluctuations, you should always factor in potential rate increases when calculating your budget. For example, if your current HELOC payment is $500, like we mentioned earlier, and payment would be, if the prime rate increased from 1% to 2% or 3%, this will give you a realistic picture of your potential financial obligation and help you avoid these incidents. Additionally, it's wise to choose investments that generate returns significantly higher than your HELOC payments. This increases a financial cushion that can absorb any rate increases. For instance, if your HELOC payment is $500, aim for an investment return of at least $1,000. This way, even if the rates rise, you'll still be stable and be able to recover and enjoy your profit. It's also beneficial periodically to review your HELOC terms and your conditions, especially when your financial situation or the market conditions may change. Some lenders offer the options to convert a variable HELOC rate to a fixed loan, which can provide stability in rising interest rate environment. Always stay informed about your options and be proactive in managing your debt. Furthermore, leveraging professional financial advice can be invaluable in managing your HELOC and your overall investment strategy. Financial advisors can help you assess your risk tolerance, develop a comprehensive investment plan, and make informed decisions that align with your long-term goals. Don't hesitate to seek professional guidance to optimize your financial outcomes. All right, the 5 steps to using home equity to buy a second property without penalties. It's a powerful strategy if you approach it with the right knowledge and the caution. If you found this video helpful, make sure you like, subscribe, and hit the bell icon for notifications. And don't miss our next video. We're going to deep dive into calculating your ROI on your rental properties without having any documentation. Trust me, you don't want to miss